No change. The Federal Reserve holding rates steady in the range of 4.25% to 4.5%. But two Federal Reserve governors, Chris Waller and Michelle Bowman, dissenting, preferring to cut rates by 25 basis points, underscoring division within this Federal Reserve over the impact of President Trump's tariffs on inflation. This is the first time in 30 years that we have seen two Federal Reserve governors dissent simultaneously. Now, there were some changes to the policy statement. Notably, officials downgraded their assessment of the economy, saying that economic activity has moderated in the first half of the year. That is a downgrade from characterizing the economy as, quote, solid back in June. They acknowledged the swing in net exports that are impacting GDP, just as we saw second quarter GDP come out this morning, and acknowledged that taking first quarter and second quarter GDP together, we have seen growth moderate. Now, they reaffirmed their view of the job market, calling it solid again, also noting again that inflation is somewhat elevated. Officials also noted that uncertainty around the economic outlook remains elevated. That compares with a statement back in June that uncertainty had diminished but remained elevated.
We have JPMorgan Asset Management Global Market Strategist, that would be Jack Manley, along with EY Chief Economist Greg Daco. Guys, great to have you here. Your reactions. First question was right out of the gate was rate cut in September. Is it happening? What's going on? And Powell sort of saying here, listen, we've made no decision about September, Greg, he says. So more of the wait and see there. He was not teeing that cut up in the presser. Obviously not going to go over too well with the president, we know. I'm waiting for the social media post, as we all are. Bloomberg does note the chances of a September rate cut. They went from 68% yesterday to just 45% now. What do you make of the question and then his response to it?
Well, it was largely expected that he would keep his cards close to his chest when it comes to what he's going to do next, because they're highly data dependent. I found one thing that was quite interesting is that he said there was no evidence that monetary policy was having a restrictive effect on the economy. That's a hawkish statement.
Right.
At the same time, he also said that the base case was that tariffs would have a one-time price increase effect. That is a dovish signal that aligns with Waller's view. And then finally, he did say that the economy looked quite solid. I think he was putting a little bit of lipstick on the economy there, because he kept coming back.
Why do you say that, Greg?
He kept coming back to the downside risks. So he said the economy looks solid, the labor market looks solid, consumer spending is slowing a little, but then he always kept saying there are downside risks to the economic outlook. I think that will position the Fed to, over the next few months, gradually see the evidence of this demand erosion and open the window for a potential September rate cut.
Yeah, Jack, he talked about how there are many uncertainties left to resolve, he says. We're learning more and more. Doesn't feel, he said, like we are very close to the end of that process, he said. What did you make of it?
I mean, I think that's sort of a given that we're not close to the end of the process from a tariff perspective. I mean, we're still finalizing rates as we speak. Literally, these things are rolling out over the course of the days, over the course of the weeks. And when you think about the logistics behind shipping goods over from overseas, the timing behind inventory builds, it is natural that it's going to take a little bit more time before these tariffs actually start to hit prices, wherever they start to hit prices, whether it's in corporate margins or with consumers going out there and spending a little bit more. He highlighted that uncertainty. Look, it makes a lot of sense. It's a word we've all been using for a very long time. Things are uncertain. He also downplayed, Greg, to your point, any sort of commentary about softness in the labor market, which I thought was very interesting. And as we talked about earlier, I don't necessarily agree with. I mean, yes, the unemployment rate is quite low, and yes, payroll gains are positive. But when you look at what's going on with the growth of the labor supply, there are some really serious handicaps to that number coming up. Our demographics are already pretty bad. Major changes to immigration policy that will only accentuate those weaknesses that we have domestically. The one interesting thing that I found, and for what it's worth, I actually do think this press conference was more interesting than I expected, maybe a little bit less entertaining than I expected. I think this was a little bit more.
You can't have it all, Jack.
I can't have it all. I got a little greedy. I'm stepping back. I'm eating my words. I'm saying, look, this was a little bit more interesting than I expected, and it does have to do with some of that commentary about are rates neutral right now or are they not? And to your point, Greg, right? I mean, Powell very clearly said that rates right now are not having a restrictive impact on the economy. But the way that he phrased it, at least to my mind, almost made it seem like there was a ... after that, where it was, but I wish they would be. Very clearly he was saying that rates are not neutral at the moment. We're not in a neutral position, because if rates were neutral, as Powell said, then they would be lower than where we are right now. That to me was very, very interesting. This idea that rates are in restrictive territory still, and I'd love to know why Powell thinks that we need restrictive rates. Like, maybe we're not arguing for a loose monetary policy, but why not just neutral? That to me is the big question right now.
Why not just neutral, Greg?
Well, I think one of the interesting elements came at the very end of the press conference, where he said that this was one of the most interesting FOMC meetings that he had attended, because the conversation was so rich. You had Bowman and Waller likely arguing for an easing of monetary policy, so there were debates around the rationale for either a moderately restrictive monetary policy stance or a more neutral one. And Fed policymakers don't have the luxury to, have much of a forward-looking, risk-taking approach. We do as economic forecasters. And when I look at the outlook, I'm seeing a couple of things that will materialize with greater visibility over the coming months. One, inflation is going to pick up. That is a given the fact that inflation is going to pick up from tariffs.
When it picks up, Greg, your point, though, correct me if I'm wrong, when it picks up, you then expect it to ease and subside? You don't think it's persistent?
No, I think it's a 9 months to 12 month phenomenon. You're going to see higher prices for a while. That will lead to higher inflation, but then we'll see essentially inflation moderate. You're not going to see prices continuing to rise at a rapid clip over the course of the next few years. That, however, is going to come on top of very large price increases that we've seen since COVID that will further erode consumer spending power. If you look at consumer spending in the first half of this year, it only advanced at an average pace of 0.9%. You know how fast it was growing at the end of last year? 3.9%.
Yeah.
That's a big slowdown in the first half of the year.
Which was, by the way, dovetail Powell's comments in the consumer saying generally good shape, but then did add, isn't spending at a rapid pace. He did mention that.
Not at all.
When Jack brings up this point too, and I want to get your take, Greg, on where the tariff kind of lands on the value chain. Is it Greg and Josh, or the seller, or the foreign producer? Powell was saying there, seems like costs being borne mostly by companies and retailers. It's starting to show up in consumer prices, and he said we expect more of that. What do you make of those comments?
I think that's absolutely on point. We're not seeing any decreases in exporters' prices to the U.S. So essentially everything for the big part right now is being burdened by corporations, by retailers. Some are trying to pass it on to consumers, but consumers are extremely price elastic. They're very reactive to these price increases, and you're seeing volumes decrease as a result of these price increases. So that's very much the case right now. I'll add one more thing that we haven't seen yet. The effective tariff rate in July was 10%. The average tariff rate announced was 15%. So there's much more tariff bite to come. And over the course of the next few days, we're going to see the average tariff rate rise from 15% to about 18%. So the shock is getting greater and greater. That will weigh on economic momentum. It will weigh on the labor market. I am concerned about this print over the course of the month of July. I think we will see very weak payrolls, and I think that will start to sound alarms amongst Fed policymakers that perhaps it's more than time to start easing monetary policy.
Jack, I want to end with you here. Yeah. Did you hear anything today, Jack, that in any way influenced, impacted, changed how you think investors need to be positioned here?
Not particularly, frankly, because there were no big surprises out of this meeting, as more or less we expected, I guess, definitionally. And B, we've been playing somewhat defensively really since the start of the year, right? Where we are right now is not a single point in time, but a continuation of a trend that's emerged for the last 8 or 9 months, which is there's a whole lot of uncertainty because there's a whole lot of change underneath the surface. And whatever's going on with tariffs and trade, right, Greg, to your point, like those numbers keep on changing. Put that stuff aside. You got changes to the regulatory environment. You got changes to immigration policy. You have changes to the fiscal side of the house. There are a lot of things happening simultaneously. They are all having impacts, positive and negative, on all these different economic indicators.
Given that backdrop, Jack, what is your advice then? How broadly do you want to be positioned?
My asset allocation views are so boring, Josh, but they seem to work well.
Boring can work just fine.
I like short to intermediate duration, high quality fixed income. I'm not going all the way out on the curve and unless, in case we get a massive spike in 30-year yields because, the Fed loses credibility or the semblance of independence. I'm not extending into credit right now. Not that there's anything wrong, but spreads just don't justify the fact that there is some macro risk sort of hovering over us. That sort of Damocles, right? That's always something that we have to be somewhat worried about. On the equity side of things, again, boring. I like large cap stocks. They're high quality. They're stable. I like U.S. stocks, despite the international run that we've seen through the start of this year. I am a big believer that this U.S. exceptionalism story from both an economic and market perspective is continuing. What we've seen recently has been a blip, not a regime change. And within those U.S. large cap companies, so we're talking S&P 500, I'm kind of splitting the difference right down the middle. I'm value growth agnostic. It's a bottoms-up security selection market. It's active management. That's it. Not rocket science, but it seems to be working pretty well.
That's it. Keep it simple. And we have Esther George now, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, always good to see you. So the Fed is expected they hold rates steady. Esther, first give me your take on that. Was that the right decision, Esther?
Well, I certainly supported that decision, and I think they telegraphed that pretty well, which is they were in a mode of waiting to see how the economy unfolds. And to be honest, Josh, they are really waiting to get some conviction around inflation to ensure that that is going to be coming back toward their 2% target.
When do you think we get that conviction, Esther?
Well, I think it's a great question. You're seeing the economy slow compared to last year. We see, I think, the uncertainty that has been plaguing the economy for the past few months playing out here. And the question is, the economy is still growing. People are beginning to understand to some extent how to manage their businesses in this kind of environment. So the things that are pushing, I think, as upside to that inflation story have to do with the financial conditions we've seen, which have eased since the Fed's last meeting. We continue to see a lot of deficit spending coming out of the government. We're going to have a lot more Treasury issuance coming out here. And the direction of travel is to deregulate. So there are some things here that I think the Fed has to keep their eye on when they are trying to develop that confidence and ensure their credibility around their inflation target.
Let's say you're in that presser, Esther, that's coming up here, which we're all going to be listening to very carefully. And you're a reporter, Esther. I just made you a journalist. And you have the chance to ask Powell a question or two. What would be top of mind?
So I think I'd want to know from the chairman to what extent they really believe the current interest rate environment is restrictive. It is getting less and less clear to me that this policy rate is really dampening the economy. Certainly, we know borrowers always feel the brunt of these interest rates compared to where they've been over the last 2 decades, frankly. But all in all, the economy continues to move forward. And so understanding the Fed's calculus, I think, around where the balance of risk is as we go into the September meeting, I think will be something I'd want to hear.
The political pressure, Esther, that Powell has been under has been intense. I'm curious to hear what you make of it. And also, Esther, just I guess a more general question of how much that Fed chair matters when really, Esther, we're talking about, of course, 12 people who set interest rate policy.
Well, the Fed chair matters a lot. This is the leadership role for the committee, a very large committee, as you noted. It is one vote, but the real responsibility of this leadership position is to bring consensus, is to provide the leadership that says, how have we taken in the information, how are we reading the data, and how do we position our decision-making for the long term, and not just a meeting-by-meeting reaction to the data. So it is a very critical role. It's one that has to focus on the long run, and the design of this institution was intended to make sure that they were able to do that.
And yet we know, Esther, of course, President Trump is not going to be happy with the decision. I'm waiting for the social media post. I haven't seen it yet. I would bet good money it's coming. Does that pressure, does it matter ultimately, Esther?
Well, I don't think it matters so much in terms of the committee's decision-making process. And again, you see today that differences emerge in this committee and our public so that the public understands where the debates are happening. But I think what's important, you don't want to confuse the public. And I do worry a bit when we see some of the disparaging remarks made about Chairman Powell and the Federal Reserve more generally. I wonder whether the general public understands the dynamics here that can affect their confidence in the institution. And that, I think, remains important for the Federal Reserve.
I don't know if you caught this, Esther. Mohammed Al-Arian gave an interview recently, and he was arguing Jay Powell should step down. The argument he was making, Esther, seemed to be, well, if he stepped down, that would actually it would diffuse a lot of this tension. It would minimize the attacks and would actually help preserve the independence of the Fed. What do you make of that call?
Yeah, I think the chairman, to be true to, again, the design of the institution, would be to carry and fulfill his term. I think that is really the demonstration of the independence of the Fed, the focus it's supposed to have. His term is not that much longer, and I suspect even whoever comes in behind him will have to face these same issues of thinking about the long-run interest of the American public.
Does the Fed, Esther, require reform, in your opinion? I ask because, and you saw this, Treasury Secretary Besson, he has called, and this certainly made headlines, got a lot of attention. He's called for a review.
Yeah, Josh, any democratic institution must be accountable and must be fully open. So I'll be interested in what particular reforms are being advocated for here. I think the central bank always benefits, and it's doing that now, right? Looking at its framework, thinking about what best serves the American public. So there's no reason not to hold the institution accountable. There's no reason not to think about whether the policy frameworks, whether the operating regimes they use are the most effective. But I would do that outside of a political leaning and try to do it in the most objective way possible in thinking about, again, how the public is best served by the decision making that goes on in this institution.
What about, Esther, I do want your take as well. An interesting thread here was the two governors dissenting. I was reading, Esther, that unusual. I believe it hasn't happened since 1993. What do you make of it? What does it suggest, Esther? What does it signal to you?
Yeah, it's unusual. I mean, I think we saw this when Governor Bowman dissented a few months ago, that hadn't happened in a while either. I think it's healthy. I think this committee, for too long, people have raised questions about whether its tight consensus looked more like groupthink than agreement. And that is not at all, I think, what the Federal Reserve is designed to do or intends to do. So I take these dissents at their face value, which is bringing forward arguments about a different way to look at the economy, a different policy preference in doing that. And the committee weighed those and came out in favor of leaving rates where they were today.